Well, I mean, the current trade tensions are a serious issue for actually both Canada and the United States. Since the free trade agreement between Canada and the United States in 1988, which actually predated the NAFTA agreement, the trade ties between Canada and the U.S. have only deepened. And since NAFTA came in, really there's an integrated North American supply chain, and trying to dismantle that is very difficult. And just to give you a sense of it, we are each other's largest trading partners, and for 31 states, Canada is their largest export market. And you're starting to see inefficiencies filtering through. Right now, I don't think what's happening is what the administration was hoping would happen. In fact, you're seeing some industries having record profits in Canada because these guys don't always necessarily have an alternative place to get the supplies they need, so you end up just paying more for it. So it ends up being the end users or the end consumers who actually pay more, and it's not necessarily hurting the producers at the time, even though their products are suffering a tariff. That said, we did see a large number of job losses recently in Ontario, which is the industrial heartland of Canada. That said, the economy seems to be growing very quickly, and we've still got very low unemployment. So it'll take a little while for the numbers to shake out. But I certainly think the longer this goes on, the worse it'll be for both our countries. In terms of investment, so far it hasn't fed through to too much. I think it's basically still to do with earnings. Certainly we've taken the approach that we want most exposure to companies that aren't going to be directly affected by that, just to trying to avoid any of the problems that you've seen going through with that. On the flip side, the comprehensive free trade agreement with the European Union, between Canada and the European Union, has come into effect, and you're starting to see a pickup in trade between Canada and the European Union. And the revised Trans-Pacific Partnership, which the United States pulled out of, but then the other countries did eventually agree on, that will be coming into effect. And we have a free trade agreement with some of the Mercosur countries and South Korea as well. So on the whole, the Canadian economy is doing pretty well. I think the biggest problem is we've been doing well for so long, not having really had the same sort of crisis, that it's not been the same, had the same sort of attraction as an investment destination as the United States currently does now. Well, I think the biggest trend that would be noticeable to an outside investor is that the energy market continues to be weak. The differential of Western Canadian Select to West Texas Intermediate continues to be quite broad, and there's a big problem with actually getting our product to market. Right now, all our product goes to the United States. There's political disputes about trying to get pipelines built to the coast, to the Tidewater, either on the Pacific or the Atlantic. And at the same time, there's been bottlenecks with the pipelines. So you're starting to see, again, oil by rail going through. And so what it means is that the weaker producers are really struggling, while the stronger ones are managing to get going through. Because of that, in the terms of the Canadian market, the energy companies have a much smaller weighting. Having been at one point the largest weighting in the index, they're now a much smaller component. You do find value, but it's often a question of your timing and the cliche of trying to catch a falling knife. I think there are some excellent companies out there, and that's the sort of thing we try and focus on, rather than try and get too strategic with the timing. Finding companies that are really good quality, that have good earnings visibility, and that we can feel comfortable holding for a long term. Often those are companies that are selling into their domestic market or selling into a market that is more local to them. I think the biggest thing right now you're seeing is a combination of, with rate rises, some of the weaker markets, weaker currencies are taking a hit as not the Canadian dollar, as the American dollar gets stronger with the Fed raising rates. And so it's the old story, it's not until the tide goes out that you find out who's been skinny dipping.